How Trump's Vietnam trade agreement will shape retail and consumer futures in 2025. In 2025, the retail landscape lands a moment of respite as it dodges a potential crisis tied to tariffs on Vietnamese goods, offering hope for retailers and consumers alike. However, some industry leaders caution that the newly negotiated trade agreement could still pose significant challenges and dampen consumer spending. The trade deal shift and its ripple effects. A search for a silver lining after the tense announcement reveals that the retail industry has avoided the worst-case scenario concerning tariffs on Vietnamese imports. But here's where it gets controversial. Many professionals in the retail sector argue that the tentative move toward a 20% tariff, while an improvement from the originally proposed 46% tariff, still presents challenges for the industry's bottom line and consumer affordability. A significant shift occurred when the proposed tariffs on Vietnamese goods dropped from an alarming 46% to a more manageable 20%. For context, this is a notable increase from the current 10% duty, but still significantly better than the earlier higher proposal. A transitional period for retail giants. To understand the gravity of the change, consider the impact on major U.S. firms like Gap, American Eagle, and Nike, who have reduced their dependence on China by turning to Vietnam and other Southeast Asian countries for manufacturing. This strategic shift was aimed at avoiding high tariffs and navigating geopolitical tensions. Notably, factories in Vietnam produce goods comparable in quality and price to those from China, which is why they became a popular alternative for these retail giants. Vietnam is now a major player, becoming the second largest supplier of footwear, apparel, and accessories for the U.S. market, with projections showing it could outpace others to become the leading provider by 2025. So what happens if these proposed new tariffs had been enforced? The outcome potentially negates the hard work aimed at reducing dependence on China. A more lenient tariff of 20% is viewed as a relief, promoting hope that similar arrangements could be achieved with other countries like Cambodia, Malaysia, and Bangladesh, which face varying tariffs. Navigating consumer concerns and market implications. As Sonia Lipinski of Alex Partners pointed out, a 20% tariff isn't an industry disaster. Still, it does have tangible repercussions. Many companies already adapt to tariffs by collaborating closely with suppliers and adjusting costs. However, price adjustments like those planned by Nike could impact consumer spending habits. For example, a pair of men's shoes priced at $95 with a 10% tariff could see costs rise by $7, $42 if the tariff doubles to 20%. Ultimately, the new tariff rates mean that consumers might end up paying more out of pocket, an outcome that isn't entirely favorable because it leaves less disposable income for other purchases. Your turn to weigh in. What do you think about the impacts of these tariff changes? Are you optimistic about the 20% tariff, or do you see potential pitfalls for consumers and businesses? We'd love to hear your thoughts in the comments below.